All right. Good afternoon. I'm Aaron Vandeford with Entercom, president here. Really excited to have our next speaker to introduce the next conversation with John Gerdes, managing director at MKM Partners. John's been a long-term friend of Entercom and certainly one of the analysts that we look at, and his analysis and thoughtfulness with the numbers certainly stands out as he takes a very detailed approach to his analysis and the space. And so I welcome John Gerdes to us today.
Aaron, wonderful being with you.
Well, thank you for being here. I want to take this time over the next little bit here to get your thoughts on certainly interesting time in the industry, where we're going, what are the capital markets seeing, and so maybe we'll just start at the very high level. Where are things today in where your vision is on where energy is and E&Ps today?
I'm going to start actually, I think because it's natural, I'm going to start really high level. And then I'm going to walk this down through the companies in the industry and how that's interfacing with the capital markets. Liquid hydrocarbons are simply two things: natural gas liquids, which is overwhelmingly a petrochemical feedstock for plastics and refinery additives and what have you, with a very durable, progressive demand outlook, with the development of humanity, especially developed world humanity. Crude oil overwhelmingly is a transportation fuel, and then secondly, an industrial fuel as well for all kinds of useful products, modern products, call it. And there's a whole wedge of the world that's still evolving to some modest semblance of some standard of living. And there's going to be energy demand associated with that. We will evolve other sources. It is a multi-decadal process. But what we see, broadly speaking, is crude oil demand continuing probably to progress in growth slightly more than where we are. In other words, liquid hydrocarbons demand last year in round numbers was a 100 million barrel a day market. We think late this decade, it's 102 to 105, probably somewhere in that window, and it begins the process of stabilizing later in this decade. As we migrate into the next decade of 2030, overwhelmingly because of evolving, maturing of global economic activity in the developing world, but also in terms of efficiencies, with a minor wedge associated with the evolution of electric vehicles as part of the passenger car fleet. We think that crude oil demand starts to stabilize late this decade and has a certain degree of decline as we look out into the following decade, the next decade. NGLs, natural gas liquids, likely continue to progress to some large degree through most of the next decade. So overall liquid hydrocarbons largely experiences a pretty elongated plateau of 5 to 10 years as we get out into about 2030. And, that is just what it is. It's natural. That's natural human evolution. That's alternative energy sources becoming more of a part of this. The reality of the matter is that overwhelming, though, liquid hydrocarbons is probably dispositioned at somewhere in gross number terms of between 100 and 105 million barrel a day market, and then that stabilizes later this decade. It has a profound usefulness in the context of transportation, and then secondly, in terms of the petrochemical industry and plastics and production and what have you. On the gas side, gas is overwhelming. It's a space heating. Highest utility is actually space heating, but its global and greatest growth attributes in the power generation sphere. And in this, you're looking at, again, evolving economic and societies beyond the industrialized world really being the driver. And that's where LNG comes in, of course, in terms of U.S. exports of LNG. That market, very reasonably because of its utility, overwhelmingly as a power source, and overwhelmingly as a complement to nuclear, solar and wind and other renewables, has a progressive outlook, a growth progressive outlook that could transcend most of next decade, globally speaking. Overwhelmingly a highly efficient fuel for power generation and a high economic utility in the industrialized world for space heating. So these fossil fuels, now coal is another matter. Coal, for humanity's sake and CO2 emissions perspective is in a state of pretty radical de-emphasis and decline in the industrialized world. That is rightful and that's natural. Unfortunately for the world, we're still in a state of progression in terms of coal generation in most of the developing Far East. That's slowing though. So coal is in a different place. Coal has finally reached a place where it is sunsetting truly as a fossil fuel. And again, that's rightful in the context of humanity's emissions of CO2. So that's where they're placed.
Let me
Back
jump
to
in
you, Aaron.
real quick. And so certainly you've given us the 10-year view. And, you know, I think we particularly in the energy and oil and gas space have a strong belief that energy, oil and gas and natural gas will be a relevant component of this mix. And you're seeing some increased demand over the next little bit. Talk to me a little bit about what you're seeing here, maybe in the near term from demand and what we've seen in this little COVID environment, while we have a little bit of a demand discussion, and how quickly does that maybe come back, or how does that set things just maybe moving in a different direction as well?
Thank you, Aaron. That's a perfect transition of the more tactical conversation of the here and now. With COVID-19, and the numbers are starting to solidify a little bit, we are looking at, in our view, is close to plus or minus about 9 million barrels of demand atrophy this year as a consequence of COVID-19, about 2x the amount of influence in the first half of the year in simple round number terms versus the second half, but the average being almost 9 million barrels. And the authoritative bodies, I'll call them, the IEA is under us and OPEC is a bit above us, but we end up being in about the average of those numbers. That's about where we're lining up. We think, and where that demand deviation really resides, the global jet fuel kerosene market's about an 8 million barrel market in a 100 million barrel system. Motor gasoline is about a 25 million barrel market, and again, in a 100 million barrel system. And what we think has happened as a consequence of this is we probably structurally, from mobility terms, have reset the demand for those, basically stepped it down somewhat permanently by about 1 to 2 million barrels for each of those markets. Now, that's 1 to 2 million barrels on 8 with jet kerosene, and 1 to 2 million on 25 million in motor gasoline. But we think that realistically, that's what's occurred. We're in a natural state coming into COVID-19 of doing about 1 million barrels per annum of growth in liquid hydrocarbons, either side of that. With that number moderating now as we look out, in the next several years. The relationship of those relationships suggest this year, I referenced, next year we're down about 4 million barrels versus 2019. The IEA would suggest it's closer to 2 million, so would OPEC. And 22, we're still down 1 million to 2 million barrels, which is really largely some of that's structural. And we see a place exiting 23 where we're approximating 2019. And from there, we go on to 102, 3, or 4, latter part of the decade. So this is going to take time. The IEA, to put some context on this, suggests we'll be back to 2019 in 2022. We think it's basically a year and change, a lot more elongated than that. And that's the mechanics underneath that it suggests to us that right now we are seeing still about 7 or so million barrels year over year down. We think that number is closer to 5 in the fourth quarter. And again, next year's average is 4. The year after that's 2, 1, and then we're back by 2024, exiting 23, we're back to reconciling 2019. So when people talk about peak oil demand being potentially last year, we don't really think people are that's that far off. But the challenge with that thesis is you lose sight living in the industrialized world of the developing world. And there is still a major evolution occurring, still residually in China, but India and other parts of the developing Far East that very naturally have increases in demand in front of them. And yes, moderation in Europe and the developed Far East, but not to the degree of offsetting that kind of progression that we're still experiencing. So that's what we see in the here and now. What we've done in terms of the world is what we've done is basically we're in the motion now in the U.S. to take about 3 million barrels or so of liquid hydrocarbons out of the system. 2 of those are already in motion that are somewhat visible by the end of next year at the current level of capitalization. That sets the condition that simply the math says we're oversupplied and built about 800 million barrels of residual inventories this year, which has basically now happened. That is reabsorbed during the fullness of next year. And by the time we exit 21, we're basically at norms. What we're setting in motion, though, is a fairly substantively structurally imbalanced system 22 forward that suggests by 23, we need to be probably in the neighborhood of 700 oil rigs once again versus the current level of 180. And what's happened in this industry is the lack of production, the production decline suggests the cash generative attributes of this industry have atrophied by about 30%. So said differently, a $55 mid-cycle world, which happens to be our current view of mid-cycle pricing 22 out, that level would, prior to COVID-19, incent about a 675 rig count, assuming 15% free cash flow positive. The industry is increasingly capitalizing towards a design around 20 to 25% free cash flow positive. In a 20% world, that would suggest $55 will only incent about a 475 rig out in late 22 and into 23. So what we think we're setting in motion here with that demand trajectory is a fairly substantive increase in oil prices. We think we'll be in the 50s later next year. And as we get out into 22 and 23, we could have a year or two where we're in 70-ish NYMEX world very reasonably, because we're catching up to the imbalances now that we'll start to set in motion, or we're setting in motion as we get out through 21 into 22 and beyond. So that's the roadmap we see. The market, this is not lost completely on the market. The stocks reflect about $50 oil prices. They reflect a chunk of our $55 long-dated view, but our long-dated view probably ultimately is probably more rightfully placed 55 to 60 than 55, but we've got a lot to go through between here and there. But I think the message, though, is we are really in the process with 180 oil rig activity of materially atrophying. If you left that alone, for instance, you'd atrophy by the end of next year about 25% of the supply. By 18 million barrels becomes closer to 13, over that period of time if you were to leave that level of activity in place. So we need to start to see levels of pricing that will begin to cause activity to respond. Aaron, back to you.
I was just going to ask you, and you're touching right on the question that I was going to ask is so certainly the capital markets have kind of said to companies, and companies have responded, I'm not putting another rig to work right now. What is it? Is there a certain price that you guys are looking at where companies may get comfortable, or the capital markets even get comfortable with a company going back to work, or are we in this period where we're just going to gain efficiencies and companies are just going to lag? They're going to build that cash flow, support their balance sheet in the near term that would maybe cause that spike a little bit more. Do you have any thoughts on what that looks like, how a return comes back?
First of all, what is extremely exciting, what's extremely positive from an economic perspective in this industry, this was an industry that 2010 through 2017 was a material free cash net flow negative business, 20 to 70% cash generation relative to capital spending. 18 and 19 was a period of in transition and inflection around neutrality. I'm rounding numbers off clearly. We were entering this year in a mid-55 deck where the industry was going to be about 15% free cash flow positive, which was a big step change positive. What COVID-19's actually done, and the concern structurally about demand, is it's actually invigorated that further. The narrative now, and it's largely being acted upon in terms of the outlook for 21 capital plans, current plans and 21 plans, is to design around a 20 to 30% free cash flow positive disposition. Said differently, capitalize about 70 to 80% of cash generation. So that's actually incremental from what the industry came into and designing. So it's actually intensified the economic potential of the industry, interestingly enough, rather than degraded it. And the capital markets are beginning to respond to this. Now, they're going to want to see some duration of behavior, and there'll be naturally skepticism given the history. But that feedback loop, as we wrote about today, actually, in our compendium recap, creates a very virtuous feedback loop for an economic industry. And so the difference is that we've got an industry that's capitalizing well inside cash generation, and there's a supply implication to do that. So now let's talk about the roadmap. First of all, the break-even levels for liquids-oriented businesses is in the low 50s. We can argue this, or the reality is that's what the full cycle business execution shows you. On the gas side, by the way, that full cycle break even is around 265 gas. Round numbers, you want to make it round numbers, 250 is gas. Companies will tell you all kinds of things, that's all fine. The math tells you that. And the companies respond to the math, just as we attempt to. So what that means is the following. We're in the low 40s in the world. What is now, and I've just gone through with the 35 odd names that we cover, which is basically, most of the companies that have a greater degree of market relevance, they're basically in motion now to complete wells as we go into August, into September. Many of them are looking at some modest degree of rig re-engagement in September or later this year. And in low 40s, that's somewhat rightful. The design being on all of them to try to create volume stability entering next year, sequentially speaking. That's the objective. Some will achieve it, some won't, actually. And so that is where they are now. But this level of pricing is going to express itself something way less than 300 rigs, probably in the 225 to 250 rigs as we get into the early part of next year, because this is still a modest level and really below full cycle break-evens. We believe by later next year we'll be in the low 50s, and that will begin to engage more substantive amounts of spending. But we think that still that roadmap will be challenged to place us much north of 400 rigs exiting next year. Of course, that's a long ways from 180. But that only way that occurs is an environment where we're rematerializing into the low 50s environment later next year. The signal's got to be sent. The industry's got the message. There's no going back to anything. There's no going back to looking at PowerPoint presentations or somebody telling me what their half cycle economics are. That's all gone. That never worked. The investment experience has been a disaster, predicated on those representations. Only thing the market is responding to is full cycle financial statement outcomes that demonstrate or don't the free cash generation attributes of this industry. And by the way, to generate an upper single digit free cash flow yield in the current level, you need to be around 20%, 25% free cash flow positive to express that yield at the current levels of valuation. So this is the thing that's beautiful about this. Aaron, the beautiful thing is that this is stuff we can measure. We can analyze, and we can hold people accountable, positive or negative or in between, versus a PowerPoint presentation or somebody telling me what their well cost is when I know full well costs are all over the map in all instances, just like landing zones, just like the productivity of any individual lateral. And so it creates efficiencies actually in understanding the economics, but it also gives the industry an opportunity to say, okay, we're going to show you cash generation. We're going to show you industrially competitive cash generation outcomes. If that happens, and there's an increasing belief it will, the market's going to respond to that, because that is literally evidence of a positive economic outcome. That's what's so hard here. Back to you, Aaron.
No, I was just going to say, this is why I love talking to you, because you let the math dictate where you guys are thinking. I mean, the math is real and the numbers are there. So I always appreciate your responses. So I want to get it, not to sidetrack you from anywhere where you're going, but I want to get your perspective on, I think, the industry's perception of maybe consolidation in M&A. And so is there size and scale? Do the numbers show that size and scale is something we've got to accomplish for this longer term investment to work? And are we going to see that kind of come through in this roadmap?
What I'd say to you, to react to your question, but before I react to it, the one thing, and I appreciate the comment you made earlier, and it's nice of you, it's sweet of you, it's nice to be with you, is what's liberating about my work and our work is that it's not about us. It's about literally just analyzing what the business models can and can't deliver economically. And that's always made this work so, for me personally, very liberating and reasonably true. In terms of consolidation, increasingly what you're seeing, again, the industry is focused on the same things the market's focused on, and that is full cycle economic outcomes, both specific to their business models, but also specific to targets. The Noble transaction, well, there's interest by Chevron in Eastern Mediterranean, the significant gas resources, and they see a full cycle economic outcome that's competitive in the industry in the U.S., not necessarily substantively more, but at least competitive. M&A is going to be, the deal with Southwestern is basically those assets are a little bit higher on the cost curve, but generally are competitive with Southwestern, which is also higher on the cost curve, their asset profile, from the return profile of their assets. Businesses are not going to buy other businesses that have a propensity to degrade their full cycle economic outcomes. So there's going to be a number of businesses out there that are going to be stranded assets. They're just not going to see a buyer unless that buyer literally does pay at or below the value, or really below the value of the production base, and it's just a bulking up circumstance. But for the most part, there's a number of business models that will be largely stranded in that context because they don't generate competitive full cycle returns. This is a mature industry. It's still a very fragmented industry. Consolidation theoretically makes sense. The other thing that's more analytical on all of this, in the case of the Noble transaction, it's a beautiful example. Noble expressed a mid to upper teens weighted average cost of capital. Chevron's closer to 10%. There's massive arbitrage in Chevron capitalizing those assets at their cost of capital rather than Noble standalone capitalizing those assets. Noble was plagued by the fact that they had Eastern Med and they had Colorado exposure. Chevron's got exposure globally, and that's all diluted beneficially to cost of capital, alone from the fact that the overall cost of capital of a major integrated is more moderate than an independent producer. So there's tremendous arbitrage in the context of that coming together. This was a home run for Chevron in the context of the economics and the coming together of the numbers. In the case of Southwestern and another recent example, this does create some incremental scale. There is a little bit of cost of capital improvement, accretion as a consequence of this. It does create a little bit more optionality in how they invest, creates a little bit more inventory depth. And so it does those things, and they bought it right. It's basically an at-market deal is actually 5% below discount. They bought it basically, and they bought it for the value of production. If anything, they bought it slightly under the value of production, but within margin of error. They didn't buy anything for capitalizing the business. They will selectively capitalize elements of the business. But what Montage doesn't have an outlet, doesn't have really an organic go forward. Southwestern's somewhat challenged, but this helps that process along by creating a bit more scale and optionality. Both these combinations are examples that were very healthy. Other healthy ones would be the Jagged Peak Parsley situation, the SRC PDCE situation. These are good industrial logic, complementary assets, scale. There's synergies clearly that are going to be very evident in these kind of combinations. But going forward, we'll see more of this. We'll see it in fits and starts. But you've got to have full cycle economic outcomes, at least in and around competing with the industry or better, to really be attractive as a target to someone bigger. Aaron, back to you.
I gotta end with a math question here for you, John. You talked a lot about full cycle economics. We certainly went into this last Q2 with income statements and balance sheets that are all blown up as a result of COVID. How are you looking at specific metrics, or are there specific metrics that maybe investors or that you're looking at to help give you an idea on how to calculate those true full cycle economics for companies?
Well, thank you for the math question. We put a slide in our deck. I don't know how much justice it doesn't, because it's two-dimensional, but it's not dynamic by nature of it. That lays out in simple terms the derivation and the formulas and a simple example of how we try to understand full cycle economics. At the end of the day, I mean, I'm an engineer by background. I'll die an engineer. I mean, I grew up as an engineer. I was blessed to spend a number of years, 6 years as an engineer, 6 years as a banker before doing any of this kind of work. In a way, this kind of work is a capstone of what I did before, and it's all informed by my experience running drilling rigs and work as an engineer and as a banker in Wall Street. It's been informed by that. I simply live in a world where I'm going to model these companies in parallel or consistent with what they do. All these companies or any company does is takes capital, convert it to resource, and produces it. And so all we're doing is taking that and waterfalling that simplistically into a production schedule. The key is you've got to use the same consistent framework so you can compare various business models. If you start moving variables or equations around, then you get lost in who's got better capital intensity or not. So we model predicated upon the capital intensity, the full cycle. And the only place I can go to get numbers that are real are a financial statement. And the only place I can really go there is I've got to go to a cash flow statement. Everything we do is about cash economics. I have conversations, I had 35 of them this last couple of weeks. When we talk about accruals, you can talk about it till you're blue in the face. At the end of the day, and I'm sensitive to timing, I try to be, but at the end of the day, I've got to analyze what I can actually observe and what's actually economically real. And the only thing that's economically real is that cash flow statement in terms of history. And then what we're doing going forward. So we're working in a window of looking at the capital intensity, capital productivity the last several quarters, and we're looking at the next several quarters. We constantly oscillate in that window. Got to have some data to analyze. And then looking forward, calibrating where we see the business model going, what the company says, and calibrating where we think the right roadmap is in the relationship between the capital business is spending and the volumes that it's able to deliver. And the key with all of that is keep it really same framework, same analytical waterfall frame, consistent across all these companies, so you can look at these companies on an apples-to-apples basis and understand the relative, not just absolute, but relative variances. And one of the tests to all of this are, we talk about a business model having a 100% recycle ratio. That basically means it's trading dollars. When you step back and look at the business execution, what you'll often find, Aaron, it's a business that volumes are relatively flat and it's spending around cash generation. Well, what is that? When you step back from that, that's basically that's just trading dollars. You're not creating value. Nobody's fault. You're not creating value. You're just treading water economically in place. And that's what that would imply. Back to you.
I love it, John. So I've had a smile on my face this whole conversation, and I've enjoyed being able to dissect a little bit of the industry. Always appreciate your perspective. And I would encourage folks to reach out to John or to make sure you take a look at his analysis, because it's pretty impressive. So, John, thank you very much.
Nice being with you, Aaron. Thank you.
Cheers.